Welcome to Unit 5, Revenue and Expense Accounts. The objectives of Unit 5 are to allow students to be able to demonstrate the skills necessary to analyze transactions that involve 5 different types of accounts: asset accounts, liability accounts, owner's equity accounts, revenue accounts, and expense accounts. They'll be able to record the transactions in any of these 5 different types of ledger accounts. Based on these transactions and the ledger information, they will be able to prepare a new report form balance sheet. They will be able to prepare financial statements from a trial balance. Let's take a look at the accounts as we know them right now. In order to prepare an income statement, accounts must be kept for revenue and expense data for the accounting period. The general ledger must contain all the accounts required to prepare both financial statements. Up until now, we've needed asset, liability, and owner's equity accounts in order to do the balance sheet. And now we need revenue and expense accounts to do the income statement. The general ledger now contains all of the following types of accounts. We have asset accounts, liability accounts, owner's equity accounts, which allows us to prepare the balance sheet. We have revenue and expense accounts, which allows us to prepare the income statement. Let's take a look at these accounts as they appear in a general ledger. Notice at the bottom we have 2 new types of accounts. We have one T account for revenue or fees earned in this example, and another one for expenses. Now we're going to talk about revenue accounts. And we know already that revenue is the proceeds from the sale of goods or services to customers. But there's many different types of ways that a business can generate their revenue. In the example in the textbook where we're talking about Goldman's Gym, they generate revenue by selling member fees. You can also, in different types of businesses, have commissions, which are fees that are paid to real estate people. You can have fees paid to lawyers, dentists, doctors, consultants, and so on. You can also generate revenue by selling products. For example, groceries, hardware, clothing, almost any type of business that you might find in a local retail district or local mall. Expense accounts. These are the costs incurred to generate revenue, as we learned in the last unit. A separate expense account must be set up for each major type of expense. Now we have to know what type of expense should generate its own special account. And the criteria is how often is the account used, or the frequency of use. If it's used a lot in most transactions dealing with expenses, then it's worthwhile to open up its own separate account. If the dollar value is a large amount, then it's a good idea to open up its own special expense account. Small expenditures that occur not too often are put into accounts sometimes called miscellaneous expense or general expense. Revenue and expense accounts are used to determine net income or net loss, and the net income or the net loss affects the capital account, and now we're going to find out how exactly. Revenue and expenses affect the owner's equity by either increasing it or decreasing it. We have an account called the capital account. This is where we record the owner's equity. And we have learned that the increase side for the capital account is the credit side, and the decrease is the debit side. We also know that revenue increases owner's equity, and that's why it increases on the credit side. We know that expenses decrease owner's equity, and because they are related to owner's equity, then they must be written on the debit side. Expenses are recorded on the debit side of a T account. How do we record revenue in T accounts? Well, whenever we decide what side of the T account we want to put our revenue, we must always think of what is its effect on the owner's equity. So we realize that revenue increases on the credit side, similar to the owner's equity account, the capital account. Therefore, revenue increases equity, and it's recorded just like an equity account. It increases on the credit side. Expenses decrease owner's equity, so they're recorded as debits. Whenever we think of how we're going to be looking at debits and credits for revenue and expense accounts, we must always think about the relationship to the owner's equity account. So revenue increases on the credit side, expenses increase on the debit side. Why do we even bother with revenue and expense accounts? Well, we have to keep track of net income and net loss, and at some point we have to add this net income or net loss to the owner's equity account. The reason we do this is to provide more information to management and other stakeholders so that they can make better decisions in operating the business and make decisions related to business in general. Let's turn to page 79 in the textbook. Here we're going to take a look at some transactions that we might run into now that we're dealing with revenue and expenses. We're talking about C. Piccolo, who is a lawyer, and on July 1st there was a transaction where he received $175 cash from a client for drawing up a new will. So how is this going to be recorded? Well, he received $175 cash, so that means that cash increases, and we know that cash is an asset account and increases on the debit side. As we just learned, fees earned is a type of revenue account, and revenue accounts increase on the credit side. So double entry accounting is still being followed. We have one debit and we have one credit, and the amounts are the same. The second transaction is on July 2nd. C. Piccolo billed the client $1,200 for legal services to close the purchase of a home. And because it doesn't indicate that it was paid in cash, we must assume that this will be paid at a later date. So accounts receivable goes up $1,200, so that's on the debit side, and fees earned goes up $1,200. Notice that we still have the transaction from July 1st, and now we add the July 2nd transaction for $1,200 on the credit side. We have an asset account and we have a revenue account that are affected by this transaction. On July the 3rd, C. Piccolo received $600 from the client as partial payment of $1,200 billed on July 2nd. So cash was received, so that's $600 on the debit side. Accounts receivable goes down $600, so that's on the credit side. The asset account was affected, and another asset account was affected. On July the 4th, C. Piccolo paid $95 to TELUS for telephone bills received today. So that becomes a telephone expense. And we've learned earlier today that expenses increase on the debit side. And cash goes down $95, so that's a decrease on the credit side of $95. Telephone expense is an expense account, obviously, and cash is an asset account. On July the 5th, C. Piccolo received a bill from the Vancouver Sun for $150 for advertising the new location of the practice. The terms of payment allow for 30 days to pay. The bill will be paid later. So even though nothing has been paid at the moment, the invoice has been received. So this is an expense. So expenses increase on the debit side. Accounts payable will be increasing on the credit side. The two accounts affected are the expense account, advertising expense, and the liability account, accounts payable. On July the 6th, C. Piccolo paid $100 to the Vancouver Sun as partial payment of their bill for $150 received on July the 5th. So the accounts payable account goes down by $100, and cash also goes down by $100. The accounts affected are the accounts payable liability account and the cash asset account. Your assignment today is to read section 4 if you need further information about these type of transactions. That's found on page 75 to 78. Complete questions 13 and 14 and complete exercise 8. Please note, do not do exercise 8F. We won't be talking about this type of transaction until next day's class.